live. Wonderful.
Let's see. So good evening, everyone. My name is Simon Misiewicz. I'm from the Property Expert panel, and we are live. That sounds like I've just come from Sky Sports then. Thank you ever so much for joining us this evening. What I'm going to do is put it all on gallery mode, so it's easy for you to see. Good. So hopefully you've had a fantastic weekend and you're looking forward to tonight's session. As ever, we are going to do a whip round to say hello and who each of us are. But before we get started, make sure if you do have questions that you do post those questions into the chat box so that we can be ready to answer your questions. So without further ado, let's go over to Bronwyn, then to Jenny, and then they can have a fight between themselves into the males in terms of introducing. Let's start with Bronwyn.
Hello, everybody. It's Bronwyn Burncombe here from the Property Investing Foundation. I can't believe we're on episode number, I think it's 7. Is that right? 7. So this is a great group of experts here. My expertise is property investing, coaching and mentoring people, very much about the education, really, really important. I'm an investor down in Hampshire, and I love inspiring and teaching other people how to invest safely. So there we go, on to Jenny. And if
Jenny,
Jenny's not there,
good. Unmute you, Jenny. Aha.
Hello again. I'm Jenny Mulholland. I'm a letting agent and I operate in Southampton and Portsmouth primarily. And we focus mostly on HMOs. We specialise in that area. We do also have some single lets, but HMOs keep us pretty busy. I'm also a property investor. Been doing so for about 20 years now, and tried various different things, including some developments, commercial to resi, and also sort of buy-to-let, rent-to-rents, those kinds of things. So that's me. Handing over to Simon.
Right, I've got to cut this one short. Simon M's got a gagging order on me, so I don't talk too much tonight. So yeah, my name is Simon Hodgson. I'm a mortgage broker. I started out in the early noughties, having learned about property investing, and couldn't find a buy-to-let broker. So I used a resi broker, kind of gave them some advice as to which products they should advise me to have, and so on and so forth. So I kind of took it from there. Through that period, I've learned an awful lot: how to lose it all, how to rebuild, build it back up again, etc., etc. But first and foremost, really, property investing, all the strategies that are out there, and yeah, that's me effectively. I'm going to hand across to Tim. Here we go, Tim.
Thank you, Simon. My name's Tim Bishop and I'm a solicitor. My firm's Banalek & Bishop. We're a medium-sized law firm. I've got about 65 staff, and within that, 22 of them do property. And we've got a specialist property investor team and a specialist team in lease extensions and freehold purchase. I'm also an investor developer myself. I've done a commercial conversion and a whole block of 6 flats, 4 as SA. I've got an 8-bed HMO. And so that's me, really. We're solicitors who really understand property investors. One other thing, if I can mention at this stage, a quick advert. I love this format, the Ask the Expert. It's like the wonderful networking meetings we all miss. But of course, you've suddenly got all these experts at your doorstep. But as Bronwyn certainly knows, we've just also launched something that actually works brilliantly alongside this. We now have online speed networking. We trialled it on Monday and it worked. So this, you get the pure information, the pure talks effectively. And I've got now an event which is pure networking for whatever you are in the country. So if you're interested, we haven't got the first one will be Wednesday week. It'll be twice a month. Email me if you're interested. Thank you for that. Over to Paul.
Evening, everybody. Lovely sunny day here in Solihull. Like everyone else here, I'm a property investor full time. I do a bit of development as well. I've got a good sized portfolio and I've got my fair share of a dozen HMOs, which I take every sector on. So professional, LHA, homeless and student. And I've also got service accommodation units, which thankfully have been fully let during the COVID crisis. In my spare moments, I'm also the operations director for a company called LMPG. And for those who don't know who LMPG are, we are the UK's biggest and best buying consortium for landlords. So anything you need for your refurb, we can provide it. So we deal with the likes of Magnet for their kitchens. And if you're into a kitchen at the moment, a Magnet kitchen will cost you about half the price of a Howden's kitchen, which is damn good value for money. We also are able to put you in touch with the likes of Worcester Bosch or Baxi for boilers, Johnson's for paints, Jewson rather than Selco. Don't mention Selco. Jewson for any of your building products. And there's another 35 to 40 other suppliers. So whatever you need for a refurb, please come see us. And I will now pass you on to Mr. Misvich, please.
Thank you and good evening. As you know from the YouTube channel, I am Simon Misiewicz from Optimise Accountants, helping you to grow your wealth whilst reducing your tax liability. As I said from the outset of this start of the video, that if you do have questions, I can see people already on the YouTube chat. So do go there if you have any questions, or indeed, if you just want to say hi, then say hi. We're going to start off with a format. People do register for this event. It is obviously live and we want to answer your questions. So I've got a bunch of questions we need to go through. So let's kick off with this first one. Chris Wills has asked a question: how do I go about securing an investor who shares my passion for getting into property development and business? How do I get in front of the right people? Bronwyn, this is prime for you. So why don't you give us a good start? Oh, Bronwyn, you're still on mute.
No, I'm fine. And it absolutely is prime. It's very much how I started out in my first year. I think I raised about £500,000 in my first year of learning. So I very much know this topic. It's really about telling everybody what you're doing. So start having conversation about property. I've never asked anybody for money directly. I've met people through LinkedIn, ex-colleagues of mine who I used to work with, family, friends, people that you think might have an interest. Now, sometimes the property people have too much knowledge in a way. Sometimes it's easier to work with people who know that property is a good thing but don't have any knowledge at all. So there's plenty of ways to find them, but it's more about the approach and making sure that you don't ask directly, that you start to have a conversation. And it's very much about getting to know somebody, what their interests are in terms of investing, what sort of return they're looking for and for how long. And yeah, more than happy to talk offline, book a chat with me outside this meeting. I'm happy to talk you through a few scenarios.
Thank you ever so much. Hopefully that's a great answer. The next question I've got, which is pointing towards tax. Now, if you don't know the rules, I will put the rules of this forum clearly on YouTube and on Google going forward. It's here not to answer any tax questions. I am your hostess with the mostest. I will not be answering any tax questions. You've been warned. That's obviously a joke, but I do want this chat to be very much around property investing rather than purely about tax. But there are a couple of questions about tax, which Simon Hodgson, I will get you back for all this, by the way, just so you're warned. So the question is on this type of one is I am currently investing in an investment property company. If I'm looking down, because I'm looking at my screen, I want to develop commercial property, which is quite a good strategy to think about, given all the changes with residential. Is it better to use an SPV and transfer the property when finished to an investment company, or should I use a separate development company? And I'm not going to go too much detail because this channel pretty much has all of the tax strategies that you can think of. So do go through those videos. But what I would say is, for anyone listening, that a limited company is limiting your liability. From a risk perspective, it does make sure that if anything goes wrong with that property, it doesn't affect your own personal assets, which is a good thing to think about. Now, from a tax perspective, unfortunately, it's not a listen to my next 2 minutes diatribe, and this gives everyone listening to this channel the right tax structure for them. In fact, that would be the wrong thing to do. you need to understand what your own personal tax situation is, and indeed what your long-term picture is. I do see a lot of people make a lot of mistakes because they look at the here and now, and then they say, what's the most tax efficient structure for me to use? Only later on, 3-4 years down the line, things change for them. They knew things are going to change, but now they have the wrong tax structure. So it's worth thinking about and sitting down, going through what your plans are for the long-term future, and then speaking with a specialist that can help you understand what your roadmap is for the next 5 years and get the right structure. So I can see a lot of people asking about, should I incorporate my property portfolio? I don't know, is the honest answer. Neither do you. And that's where I think a specialist and a good conversation needs to be had. There's no generic answer. I could easily say that high-risk taxpayers should use a limited company, otherwise Armageddon will happen. But that's true, and it's not true, because in 5 years' time, you might give up your job, which changes your whole kind of tax position. So that really wouldn't work for you in terms of using a limited company. In fact, you pay more tax because of it. So please don't take any advice from Facebook, YouTube videos without really having a good conversation first. And hopefully that sets a stall out really for all of my other answers that I give throughout. But it's not something I can really give you a full detailed thing for your personal circumstances. The next question, which is from Duan De Freitas, I like that name, De Freitas. I would like to know about what would count as an allowable expense for property. And this will be good for people, the panel members, as well as everyone else listening to. And it is something called the 3 R's. Now, the 3 R's is something that came up from HMRC. Funny enough, the 3 R's, which is a marketing concept, if you think about it, came from the pages of HMRC. I didn't think they'd be very good at marketing. Now I've been proven wrong. The 3 R's, basically, if you want to get your pen and paper ready, stands for repair, replace, renew. So allowable costs, if you want it to be offset against your income, will go in those 3 buckets. As a reminder, replacement are for items that you might replace. So if you are going to, here's a pitch here, if you go to LMPG for a good discounted bathroom suite or kitchen outfit, then the cost of replacing an existing kitchen would be 100% tax allowable to offset against your property income. If you're repairing the doors from your cabinetry in your kitchen, which again, you'll be using your LMPG discount membership and getting those doors from Howdens or whoever, magnets it might be, in fact, then those costs would also be 100% allowable. And then finally, you might decide to do renewals. So renewals is paintwork and replastering. Notice the letters RE. This is not a religious education seminar. It's just RE through all these words, which means that you can get 100% tax allowable costs. Renewals is paint. So you might go and use your LMPG membership. That's the 3rd upsell, to buy paint for your walls, and you might get that done. You might decide to replaster some of the rooms, so you might need some plaster bags. Again, 4th, use LMPG discount to get those plaster and make sure that your walls are smooth, and then to do a nice paint job. All of those costs will be allowable to offset against your property income. And if you have a loss, you can carry that loss for as many years going forwards. And that's how I became tax efficient for about 8 years. I did not pay tax on my property income for 8 years because I was buying properties that needed tender, loving care, which is using all the 3 R's. Wow, done with that. So let's go through Fard Gondal, who's asked the question, property investment strategy. Fard, I'm hoping you're watching because I see a couple of emails coming from your good self recently. So it's nice to see a client on here tonight. Property investment strategy for the next 12 to 24 months, given COVID. Again, what I would do is let's bring on Bronwyn on for this one, Jenny, and then let's go with Paul.
Okay, so repeat the question again for me.
Yes. So what is the best property strategy for the next 12 to 24 months?
Oh my goodness. Well, it depends is a lot of the things saying, depends what you're trying to achieve, what you want to achieve and what your goal is. Obviously, you're talking about the potential R word, the recession. That's another RE word, Simon, isn't it? Will there be a recession? Well, yes, of course there will be. In terms of our economy, we're not going to be growing as quickly, or we might even be going backwards. But how's that going to impact the current property market? Well, will property prices go down? Possibly, and it depends where you're investing and what the economy is in that particular area. But I think there's always opportunities. The big thing is that people will always need somewhere to live. I think the rental market demand is still going to be very, very high. It's really about where's your sweet spot? What have you got interests in? Short-term letting, long-term letting, all those sorts of things. There's plenty of different avenues there. I did write down, some answers here. I was thinking about universal credit because I've been with my HMOs. I've got a couple of HMOs where I'm actually helping the local council. So there's a lot more benefits now that people can claim for from universal credit and from the council, so that if they've lost their job, for example, why not get the government to pay for our rooms, because people have got much higher demand in that area. So that's one area that I've certainly been doing more in. Other people's views. Jenny, over to Jenny. Unmute.
Hi. Obviously, I agree with what you've said there, Bronwyn. Couple of things that come to mind. There's been some relaxation of planning laws, which mean it's much easier to do some of the projects that you might not have decided to encounter before. If you haven't got to go through planning, if you could do something with prior approval, that's got to be a massive, massive bonus, because the time it takes to get through proper planning for a development or a conversion or whatever you're looking to do could kill the project simply on cost of finance, because it takes such a long time, maybe 18 months, 2 years to get planning through. And who knows, with the the current situation, that could be longer. So anything that you can do on prior approval, which might be extensions on properties, it might be conversions to your office to resi. There's going to be a lot of offices not in use, those kinds of things. But also touching on what you said there, Bronwyn, on using some of the council's ideas. General buy-to-let HMOs type things, I feel at the moment it's not a great place to be. It's so overtaxed. It's very penal to be in that market, so it's not a great place to be starting out right now. However, there are councils, particularly locally to me, Portsmouth Council, not Southampton, will take an entire property from you and give you a guaranteed rent on it. Now, that's okay. You're not guaranteed rent situation. You're not going to get any voids, so you've got guaranteed income there. So anything you can do along those lines, I think, would be quite nice and secure. So if you want to think, something perhaps is achievable, smallish, not too risky, something like that. If your council is open to taking a let from you directly, then you don't have to deal with either letting agents or voids or tenants or any of those issues. So that's a good place to go if you want to be small, starting small, and maybe then looking at some of these planning relaxations if you want to do something a bit bigger.
Over to Paul.
Over to me. Well, let's say it all depends. Depends where you are on your journey. And therefore you need to review. So sorry about that. Have you got a business plan? You need to know where you want to go to. So I would say, if you're new to property, then the safest way is probably vanilla buy-to-lets. So let to single families, but it's not necessarily got the best return. If you're a bit more adventurous, then look at HMOs, but be careful of Article 4 areas. If you're into systems, then by all means look to do service accommodation, but make sure you've got the systems to operate it in. Otherwise, it'll become a job for you. One thing that both Bronwyn and Jenny mentioned was universal credit. Who knows what's going to be like in the next 6 to 12 months. When furlough completely finishes in October, if indeed it does, then will there be thousands, hopefully not, but thousands of people made redundant? Therefore, your vanilla buy-to-lets may be at risk. So looking at LHA tenants could be a good strategy. If you're well on your way in your property journey, then obviously you've got developments, which Jenny mentioned, but higher risk, but higher rewards. So good old RE. We're certainly doing our RE tonight. So I think that answers the question. It all depends.
On a side of that question, someone's on YouTube Live. Special Callie has asked a question. Well, I'm planning to begin investing with £50,000, but want to build this up by flipping my fund for long-term investment plans. Is flipping viable in the current marketplace? Do you know, I'm going to go with first Simon to talk about that from a financing perspective, but back to Bronwyn if we can finish off from your views about flipping.
Right. I mean, flipping is certainly one of the most lucrative ways that you can make money in the property market, but it definitely does require a degree of intelligence, i.e. education. No doubt about it. It was the first thing I did when I got into property in the early noughties. And when I look back now, I thought I was well educated, and I'm not so sure now. So just to give a quick rundown, in today's current marketplace, we're experiencing a little bit of a bubble in terms of we've come out from lockdown. There's been money awash within the economy, bounce back loans, etc., etc., etc. And sales are buoyant, certainly in the southwest, leading into the southeast, going up to the Midlands. It's not uncommon to see properties going over asking price. So to get a deal that works as a flip is really quite hard to do right now. But if you can find one that's priced okay, you need to be super, super, super quick to get it back on the market. And just be aware you are taking a big risk, because the market can change, and it potentially will change quite quickly. That said, yeah, it's risky. Is what I'm going to say. Ultimately, would I be doing it right now? No. If you have a pot of cash, what you got to remember is if you mistime it, you pop your cash into the deal, the market moves from you whilst you've invested your cash is now tied and locked away, and you are no longer able to take advantage of what probably will be a changing, falling market at some point. Mm-hmm. So just be really careful, I think, yeah.
Yeah, so my view is, yeah, you do need a good education. You do need to have some experience, learning how to buy below market value, perhaps from a motivated seller, somebody that needs to sell their property quickly, or one that is in need of a huge amount of added value. But that's a big project, especially if you're starting out. So I don't recommend flipping as such, unless you're very, very good at refurbishing quickly, as Simon said. I think it's too risky, you know, financing it, also getting whoever's doing the refurb to do it on time and to budget when your margins are going to be quite tight. But if you want to learn more about how to find motivated sellers, more than happy to have a chat outside this meeting. You know, I can show you how to do that.
Just to add in there, then I think another point I just thought of, if you are going to do a flip, and do bear in mind we are suggesting that is a risky thing to do right now, and you need to make sure that you can do the work within the next 4 to 6 weeks maximum. I would wholeheartedly recommend that, let's say you're selling, you're looking to refurb into, let's say, the 2-bed flat market in whatever area you're in. There are two different areas you can go for. You can either go for price or you can go for quality. Okay, and the idea is to get as many offers on the table from prospective buyers to then be able to choose who is the most proceedable of the likely candidates that have got their offers on the table. And it might not be the highest offer. It's the most secure and the quickest offer, Okay, and generally that I found the way to make that work is, rather than go for price, make sure that your product looks different and has the wow factor to everyone else in that 2-bed, £250,000 market space, so that everyone who's looking for a 2-bed flat in that price bracket walks in yours and they want to offer on yours and not the other ones down the road. And if the market changes, all of the other properties that haven't been done to a certain specification, yeah, the only place they've got left to go is price, and it's a race to the bottom on price. But if you've created something that is unique, okay, whilst you will have to adjust your price slightly, you only have to adjust it ever so slightly in order to ensure that you get the deal. However, you've got to be really, really, really quick to do it in today's current marketplace.
Good. I think that's very good answers, to be fair. Shouldn't go into that. I think, unfortunately, Tim's been a bit quiet, so let's bring in him now. William Raig, who I think Roy, sorry, has asked a question. I have agreed to purchase a house that has 2 titles, a freehold title and a leasehold title. My solicitor says the titles must be merged, but the sellers do not have the original or counterpart lease. They appear to be lost. Will this present a problem with land registry in terms of my ability to merge the titles? Tim, what are your thoughts?
I'm not a convincing specialist, but I've got a whole team who are, and I ran it past one of them earlier, and his immediate response was fairly simple. He said, well, why merge at all? We're not entirely sure why the solicitor was merging. I can't double think and work out what he was doing. Basically, my colleague would normally say, as a matter of course, he would avoid merging titles. He said in particular that, in fact, the lease may have certain rights that otherwise you'd lose in a merger. So I suppose our point is why. I'm not entirely sure why they need to be merged.
Okay. Short and sweet, isn't it?
Yep.
Answer. Okay, so the next question is, Sammy Sang said, if a person has a home mortgage free, do they transfer it to a limited company? The answer to that is no. Why would you ever transfer a home into a limited company? Doesn't make any sense at all, to be fair. So I would probably stay away from that. Steve Cunningham said, limited company lettings business. Can I be VAT registered? How do I claim back VAT on refurb? And that's an interesting question. I'm not sure why I'm looking at that camera when this camera is on, so apologies for that. Not very professional, the people looking, and I've lost my job opportunity. So the question is, just to reflect, is can I claim back VAT on my refurbs? And the answer to that is, well, if you're a rental business, a residential property, you don't charge VAT. And therefore you cannot claim back VAT. So the answer is no, unfortunately not. The next question I've got is how to raise capital for a property investment. One of the questions I've got for you, Simon, just to bounce back, and this came from last week's session that you was with Bronwyn, really, is about mortgage interest rates in limited company, mortgage interest versus your own name versus limited company. My question is it an idea to raise finance from your home? And I'll be interested in Tim's viewpoint on this. We know that home mortgages is cheaper than buy-to-let mortgages. And yet I have clients, and I'm sure you've got clients, that have got unencumbered homes because they feel that they shouldn't really have debt against that. And then they raise finance, buy-to-let mortgages on their property investments, which have got a greater interest rate. Now, my view is, well, why don't you raise money on your homes? Let's go to Simon and then straight to Tim on your thoughts on those.
Okay. Yeah, I would have thought it was entirely realistic and responsible to do that. Obviously, we're not giving independent mortgage advice here. If you have equity in your home, you can definitely utilize it at a better interest rate than you can generally on a buy-to-let product. Yeah, absolutely. You can also use it as a revolving credit facility. So if you don't want to take out a proper fixed mortgage, you can have a revolving credit facility whereby the bank will allow you to draw down against it in order to buy projects, carry out refurbishment work, then have the property revalued and then pay back the revolving credit facility. Yeah, they're pretty good. Yeah, you can use it that way. You can always use it as a second charge on a bridge. So let's say you've got a really rotten property that needs an awful lot of work. Yeah, you could use equity in your house as the deposit from your home, carry out the work, add value, remortgage, and then pay down the charge. So there are a number of ways you can use equity in your house, and should do, I think, really, as an investor, as long as you do it wisely. That's the number one rule.
Tim, come on.
Hi. Yes, I can share too. Yes, broadly, I agree with you guys, with one possible exception. And this is why I think so many of the answers we're giving tonight are accurate, in the sense that it really depends on your circumstances. And the question here is risk. If you take a big mortgage out on your own property and you use it to invest, and that investment goes pear-shaped, well, of course, your own home is at risk. And for some people, that's a real problem. Some spouses or family members, or even people at a certain age, or depending on their resources. So it can be a risk. If you take out a mortgage on your own house, your own home is at risk. Apart from that, once if you're okay with that, then I think it's extremely sensible. Rates are much cheaper, and I'll be honest, I'll put my money in my own mouth. It's exactly what I did about a year ago to fund some property work. So I think it's a good idea, provided you're happy and you know about the risk. If you're not, then frankly, probably not the way to go.
Yeah. One question that came from I shan't mention who it was, but it says, how do I learn on Bronwyn's program? Bronwyn, would you like to share how someone might be able to get onto your program?
Of course I would, Simon. This is such an important question. No, I have an online program. It's called Property Investing Foundation. So you can find it on propertyinvestingfoundation.com. The great thing about an online program is that I've got 15 modules starting right from how do I set my goals, what strategy is going to be right for me, right through to development, and it covers the basics really. Very easy to watch, and I do coaching as well. So it's easy to find me. Just send me an email, book a call with me, and I can explain what my program's all about. And of course, I haven't mentioned my book yet. So on my program, you get my book. Now, I don't know where that shows. There we are. Yeah. Oh, someone else has got it. Look at that. That's even better. Yeah, I wrote a book that published earlier this year, so called Building Your Dream Life. That also has got a lot of top tips, a lot of problems in there that I faced and how I overcame them. So yeah, I love to help people learn. Thank you. Great question.
I actually staying with you, Bronwyn. Kashmir Gill has asked the question, how do you put together a 2, 3, 5 year property business plan? Now, how do you put that together? What I'm going to do is bring Jenny onto this one, actually. So I'll have Bronwyn first, then over to Jenny in terms of business plans. And Jenny, if you talk from your experiences yourself, but also from what you see of your clients.
Yeah, business planning. Yeah, everybody's different. People like to learn in different ways, but also people like to plan in different ways. It is important to, I think achieve your goals is to understand what's your end goal. So in 5-10 years time, where do you want to be? 5 years I usually find is a little bit easier. In 5 years time, do I want to have replaced my corporate income? Do I want to have a certain amount per month? And then you bring it back and say, okay, so this year, what sort of income am I looking for? What sort of cash flow am I looking for from my property business? And what does that sort of translate into in terms of strategy? What's going to work for you with your risk? So there's lots of different ways of planning. You can either go to the nth degree of analysis, or you can just be a bit more sort of focused on, well, actually, what's realistic. So yeah, that's my views at the moment. Jenny.
Well, obviously, goal setting is very important. You need to know where you're going. But I think what you also need to be very, very careful about is that it needs to be fluid. It needs to change. Your goal will still be the same, but perhaps the timing might shift on it. And you don't want to be beating yourself up too much about not actually achieving something in the time frame perhaps that you set yourself, or getting an investment that doesn't give you quite the percentage return that you were expecting, or you hoped for, or you planned for. And I think every time you can take a step forward, you should be patting yourself on the back, giving yourself a little sort of review of what went wrong, what went right, what was good, what wasn't, so that you can, the next time you take another step towards your goal, you are, if you like, you're learning from everything you do. Personally, on an annual basis, I do a kind of vision board, what I'd like to see it the next 12 months. I do have a longer term goal. I have a 5-year goal, and that 5-year goal is retirement. And so actually there's quite a lot of tax planning in that goal, because You know, that involves getting rid of some assets and sort of tidying things up a bit. But my immediate goals leading up to that are all short term, so that they're stepping stones towards that retirement, which is my 5-year plan. And I think strategies and everything will change as you might set out wanting to do, you know, buy-to-lets, HMOs, single lets, that kind of thing. And then, I don't know, find your feet a bit and want to go on and do something a bit more like developments and stuff. So these things are going to change as you go along. And I don't think you should be afraid to change your plans as long as you're always moving forward with them. And as far as I see with landlords that I work with, they very often set off to do one thing, but find themselves doing something entirely different. And that's absolutely fine because they're moving forward. And I just think that you need to have an idea of where you're going, but not perhaps be too strict about it, because you might miss an opportunity at the siding, if you like, that actually works much better for you, fits your personality better and your risk profile better.
And that's a great answer, to be fair. Thank you, Bronwyn and Jenny as well for those answers. One question that's come up, and it's a question that constantly comes up about bounce back loans, recent mortgage payment holidays, etc., etc. Simon, I appreciate you're probably sick to death with these questions, but to be fair, you do ask me a lot of tax questions, so here you go. What do you think about bounce back loans, mortgage payment holidays? How does that affect a property investor looking to get a new mortgage?
Okay, I'm sure we've covered a bit of this in the historic videos that we've created, and we definitely did, I think, with Bronwyn and I. But for those who haven't watched back on those, and I strongly recommend that anyone watching tonight does watch back on those, because there's always learnings to kind of key in. Mortgage payment holidays are a definite no. Okay, wherever possible, do not do it. If you have done it, as I've stated before, if you have the financial ability to go back to your current lender that you took the mortgage holiday with, or still are taking the mortgage holiday, and pay all of the money that you owed for the months that you took the holiday in from them, and then go back to them and ask them if they haven't already done so, or if you actually know, you should check your credit file before you do that process. So make sure, so some lenders will mark you down as having paid on time as normal regularly if you've taken a mortgage holiday. Other lenders will report it slightly differently and might put a U, which is an unspecified, which is like a red herring to another lender. Okay, so first and foremost, try and cover up all of your tracks on mortgage payment holidays. They are the worst things you can do at the moment. The government said that they wouldn't affect your credit score, and they don't affect your credit score, but they do affect your mortgageability. There's no doubt about it whatsoever. Most lenders are looking for either 3 or 6 clear months payments. Sorry, there's sun coming through the window there. 3 or 6 months clear payments before they will then look at and think about lending more to you. So that's why I'm suggesting you do that. In terms of bounce back loan is an interesting one. Most lenders are saying you can't use it. They don't want it to form any part of the deposit. However, a couple of lenders very recently have said that if the SPV that took out the bounce back loan still has the money within the confines of the business, and it is a logical thing for the business to have borrowed that money, they will allow it to be used as deposits, which is a real step change. But I do caution there, most lenders are still saying, no, we can't accept it. So the thing to do there is effectively use the bounce back loan for anything other than deposits. So works, other expenses, material expenses, your LMPG membership. No, it's not that expensive. I know. Yeah. Planning, education, tax advice, Simon, even. Yeah. And kind of going back to the last question, the 5-year plan, is definitely work your way backwards. Start with 5 years, work your way backwards. Yeah, we have a habit of overestimating what we can do in 12 months and underestimating what we can do in 5 years. Yeah, for sure. But yeah, certainly in terms of bounce back loans and mortgage payment holidays, that's really what should be done. And if your lender has marked you down as late payment and does not want to change their payment entry, I would suggest you strongly ask them to refer back to the phone call that they recorded when you phoned in for the payment holiday, and ask them to tell you where on that call they told you that it would affect your ability to get mortgages moving forward. And if they didn't tell you that it would affect your ability to get mortgages moving forward, they are duty bound to sort the problem out. They will be very unhelpful. Not the word unhelpful is not the right thing. They will not be particularly motivated to sort the problem out. But trust me, you need to help them understand that they need to be motivated to sort it out. Thanks, Simon.
Well, keeping with you, actually, Simon, hopefully you've got a drink because you're on there for the next 25 minutes. One of the questions that is now, there's a bit of a chat going on in YouTube Live, which is great to see. The question is around limited companies. People are saying, and Darren, just so you're typing in there, do you refer to SPV as limited company? Yes, we do. But there is a debate going on about, should you be buying in London? I'll come on to Bronwyn in a second about buying properties in London. But before we do that, Simon, the question is around, limited company interest rates is typically, if you disagree, do let me know. Yeah. But typically it's between 1 and 1.5% more in a limited company than it is in your own personal name. Absolutely. So there is this debate about a limited company can save you tax, but you've got to trade off the interest that you be paying in addition. What's your thoughts on that, and what's your clients going through whenever they're going, should I use a company structure? What's the rates? What are your clients kind of concluding when they weigh things up?
Right. This is a really big topic. So without question and without doubt, the first thing I say to them is, you need to understand where are you trying to get to in the next 5 years. So it was a really great question. Then I ask, have you had independent tax advice? And if not, you need to go away and get some, because quite often people starting in their property journey can buy single lets. It's a great way to cut your teeth and start learning. Yeah. Rents currently at the moment are on the increase, so yields are increasing on single let properties. And yeah, if you plan to replace an income, i.e. then no longer work, you have tax liability headroom with which you can utilize. So where you can borrow at really cheap rates but not necessarily get as great high yields, that's a great thing to put into your own personal name potentially. And then for the more complex properties that you might be buying, HMOs, etc., you won't find that you're going to save much in terms of interest rate by putting it in your own name or a limited company. So that kind of property then has possibly a clearer defined placement in terms of whether it will go in your own name or a limited company. Sure.
And that's a misconception, isn't it? Because even I say that it is more expensive to purchase a buy-to-let property in a limited company for mortgage interest rates, but that might not always be the case on complex transactions like HMOs.
Yeah, absolutely.
Which brings me to my next question. Joseph is asked a question, what will happen to the property prices? Now, Tim, I'm going to come to you on this one because you put on LinkedIn about the SDLT holiday in terms of, having this £500,000, there's no SDLT banded rate. And you said that there's going to be a concern over property prices from next year. Obviously, we will be entering the recession because of COVID. You mentioned about Brexit as well. And this whole thing may be fueling the wrong kind of thing. So what's your views, if you don't mind sharing with the audience, of what might happen with property prices next year?
I think the first thing is no one knows. But having said that, it's worth making an educated guess because otherwise you're completely in the dark. I suppose I'm looking on past history. Recessions are often caused in housing dips by lack of confidence. And certainly if you look back, the removal of what they're proposing doing in March, in other words, the SDLT holiday comes away and the price goes up immediately. That's similar to what's happened in the past. MIRAS, tax relief back in the 90s, that was removed and immediately caused a market crash. So there is precedent for this. It's all about confidence, and so the market will get very excited. Everyone will go in, and then suddenly and there'll be an absolute frenzy on the last week. I remember when we've done this before, the last week becomes horrendous for conveyancers because everybody has to finish on that particular day. And there's just this rush. And the next day, it just dies. The market just dies. So a bit like we've gone through with lockdown, the market was so-so, and then it died overnight. We could do the same again. Added that to all the risks of unemployment in the autumn, and then Brexit. I know Brexit technically has been done, but in reality, nothing's happened. And so I know a lot of people don't like talking about it and think I'm a bit of a moaner, but actually none of the actual trade deals have been done yet. So we have no idea what the impact of Brexit is going to be. So all these things mean I think there is a significant risk that next March, if not before, prices could take a tumble. No one knows for sure. I'm certainly not buying this year, and I'm intending to buy next year, depending what happens to the market. My current estimate is that things will crash, and it will crash in quarter 1 or 2 next year. Also, recessions don't happen very quickly. Even the last one, it took 9 months to go from the peak to the bottom and then 9 months to come up. So I think all sorts of people are expecting instant excitement in the market with what's going on. But these things take quite a while to happen. So if I was, well, what I'm going to do is sit on my hands and build up some cash and see what happens next year, because none of us know. But I think there is a severe risk, and the stamp duty holiday being removed may make it worse.
Thank you for that. One question that's come up and bounced up a couple of times now this evening is about inheritance tax planning. One of the misnomers, I've got to be honest with you, and this goes to your question, is should you use a limited company for inheritance tax planning? And forgive me when I say this, but a property is an investment. An investment is always going to be subject to IHT if it's in your personal name or indeed a limited company. Now, there are ways of mitigating it using growth shares, etc., but they are complex. I'm not sure how long growth shares, freezer shares are going to last for once HMRC say, well, we want IHT. So I do kind of think we need to caution that, but typically I would say that an investment company is one of those things that it's going to be subject to IHT, whether it's in your personal name or indeed a limited company. So if you're looking for IHT planning, make sure you speak to a specialist about it. It's such a big area, and you could make huge mistakes just by listening to something like this. So my advice to you, talk about IHT, is sit down with someone, go through things properly and go through that. Now, let's just go through another question. We'll talk about expats for a second. I'm not sure how many panel members here deal with expats, but the question is, Dinesh said, my brother now lives in the US, but is a British citizen. I know a bit about that, so I'll talk about that in a second. I want to start purchasing buy-to-lets here in the UK with him. What would you advise in terms of expat mortgage finance? So Simon, back to you, my friend. Expats, we are going to be doing a project amongst this team talking about people from Hong Kong. So if you're listening and you're from Hong Kong right now, what you're doing up, it's late, you should be in bed. But more importantly, we are going to do a project, a side project from this, talk about expats. But Simon, from your perspective, what are the interest rates for expats, and should expats use limited companies?
I think first of all we need to define whether that is going to fall into an expat mortgage case. Now, if the brother who's written the question in is currently based in the UK, we need to know whether they have UK citizenship or not. If they have, then it is a hybrid expat mortgage where we would probably put brother in the UK as lead applicant, and we would then support the application with the US based expat. So therefore, it probably isn't going to fall into an expat mortgage itself. It will go on to normal mortgage rates. They're easier to do in limited companies than they are in personal names, but it's still doable. And then the usual spread kind of sits there. If, however, the brother in the United Kingdom hasn't got status in any way, shape or form, then it is a full expat mortgage where we potentially go off brother in the USA. There are enough companies still at the moment lending expat wise, so you can do it on multi-unit blocks of flats, you can do it on HMOs, you can do it on single lets. Interest rates are broadly similar. Certainly if you're looking at HMOs and limited company mortgages, there's no real penalty in terms of lenders. If it's in your own name, marginally we might pay a little bit higher in rate. That's another super specialist area in terms of tax advice, Simon, so I might have to throw back at you. because obviously the interest rates are much lower for single lets. And if it depends, I guess, how long you're going to be expat, etc., etc., etc. Yeah, because if you're going to be expat for a good long time, yeah, then effectively you could buy in your own personal name and buy a number of properties and save them right. So again, we need to know where is it you're going, year 1, 3, 5, and then build a whole picture, and then we can work re-engineer it, work backwards, and do it correctly. So long answer, I think, on expat mortgages. Have we had anything back actually from brother in the UK on Facebook to confirm whether he is?
Well, definitely not on Facebook because we're on YouTube. So that's sorry, YouTube, for that. Wow. Oh. I can't. I will sack him. Yeah, you're right. There's a message straight away from YouTube saying, "Who is this guy?" I apologize. You can write an apology on your lettered headed paper. That would go down well. No is the answer. I would suspect that the person that wants to invest is British but lives in America.
Okay. Yeah, standard expat mortgages then. Yeah, they're not too difficult.
Okay. I've got a question from an aside, because people will want to invest in London, and we talked about mortgage interest rates. I don't want to get you involved too much quickly on this one, but maybe I'll bounce this over to Bronwyn and to Paul, talking about investing in London, because I've got to be honest, if people talk about getting a good return on investment, not return on capital, I always say that London is the worst place to invest. But starting with you, Bronwyn, then over to Paul, what's your thoughts about investing in London for return on investment?
Okay, so if you are buying, then yes, prices are expensive in London. But like any city, there's always going to be little pockets where you can be buying reasonably. So the ex-council houses that tend to be a little bit bigger than the most, perhaps you'll pick up something a lot cheaper in certain areas, certain boroughs. Obviously, you've got to be careful that people are happy to live there. But I do know people that have got very, very good at finding their sweet spot, the strategy that works for them, particularly buying, say, a 1-bed house and converting it into a 2-bed house, by creating another bedroom, by finding really motivated sellers and doing some refurbishments. So there's possibilities, but it's harder. Absolutely agree, it's harder. But there are other investment strategies you can look at rather than perhaps buying outright. You could do a purchase lease option. That's where you're working with the owner and you're perhaps adding the value to the property, but not buying it yet. Now that can work really well in London. You can find possible negotiation with an owner where you can do all the work and they get a little bit of rent or lease for it. So there's all sorts of things that you can consider, but of course you've got capital growth, which you mentioned. In London you're always going to get capital growth in the long term, but yeah. Any other? Paul, over to you.
Thanks, Bronwyn. Yeah, excellent idea, PLO, purchase lease option, as it helps reduce the risk. But bear in mind what we've been saying tonight, especially what Tim mentioned about 5-10 minutes ago. There is a big risk of I won't say a crash, but a correction, shall we say, in Q1, Q2 next year. It may even start to occur in Q4 this year, although the stamp duty correction, reductions will help to resist that. The other thing is that prices in London, I understand, have slowed recently because everyone's looking to move out of London because if they've been locked up in a flat in the centre of London, they are looking to get out and get some green space to move into. So just be mindful of that. I always say, for those of you who don't live in London, invest locally, because that way you can get to know your area, and that's crucial when you're looking to invest, especially for the longer term. Capital growth will occur wherever, it does occur far better in the London area, but it does occur around the outside of the M25. So just bear in mind, look a bit further out to see what the opportunities are. But yes, just be careful. The next 6 to 12 months are going to be a very interesting time. And we all know when the best time to buy is, don't we? 20 years ago, as they say. Second best time is now. But, as Tim said, and it wasn't legal advice. It was sensible advice. Just sit on your hands. So anyone else want to chip in?
Yeah, actually, I will caveat this with it was a safe, socially distanced debate that I had with some parents of my son's friends, effectively, and we were catching up. We were talking about how they found lockdown, how they found working at home. These are guys who typically work out of London, will go into London 2 or 3 times a week, sometimes more. They're then flying out to other destinations. And they were telling me that they don't envisage working back in their office at all in London. In fact, some of their colleagues who are London-based are actively starting to look slightly further afield to have a better work-life balance and a bigger home. Now, who knows how big a trend that's going to be, but it's certainly a trend that is going to be there for sure for the foreseeable future. And they were kind of telling me that their boss had been really resistant to working from home for years, and this was forced upon him, and he's now a firm advocate and he's really embracing the idea of being able to not have the big flash London office space, and is it's really fascinating. So I think that as a backdrop with London is going to be a very interesting and hard to call market, certainly in pockets of it. And I'm wondering whether you've seen this, Jenny, but the local estate agents I've spoken to have seen an upsurge in demand for properties, family properties, detached properties. Really very interesting, very, very interesting. So I'm not sure London is for an investor, if you haven't got, or we're unsure of the short-term capital growth, you're not going to get a yield at the moment. You're either buying into London for medium to long term, which, you're going to get some capital growth, or you'd be better placed parking your cash elsewhere, I think.
Jenny, let's come on to you about that. I mean, what's you seeing in regards to all that's been discussed here?
Well, I don't really work in that marketplace. The majority of what we do is HMOs. We do have some single lets, and we have one extraordinarily expensive single let on our books at the moment. And the only interest we're getting in it for it are people who are currently abroad wanting to come back here with money. Local people can't afford it, but the interest is coming from overseas, which is very interesting. If you read the property press, they're saying that there's rent prices are going up. There's a spike in the prices. What I'm finding in the marketplace that we're in, which obviously with HMO rooms is pretty much at the bottom of the ladder, is it is incredibly price sensitive. We are letting stuff, but even £15 a month on the rent makes a difference. So price sensitive right now, and I don't think that expensive rental properties is perhaps the place to be right now.
What about COVID? Obviously, you've got HMOs, you mentioned that. Are you seeing any particular issues with tenants wanting to go into a property? What if someone does feel sick? What are you advising landlords?
Okay, so obviously that's a huge issue, but the only way you can really attempt to control that is by asking a lot of questions. Obviously, before you do viewings with people, before you move anybody into a property, you're needing to be asking them if they're well, if they have any symptoms. We actually get them to give that to us in writing. When we're moving people into a shared house, before we do so, we recheck with the tenants in the house that everybody is well. We've had a couple of instances where a tenant has gone into isolation for a period of 7 or 10 or 14 days, and the rest of the household has been very much on lockdown. But actually, of the properties we look after, that's really only happened on a couple of occasions. And I would say this month, and we've been very lucky throughout with the rents as well, but this month, the two people who haven't been paying rent through because of losing their jobs or not falling between the cracks in the support system for no income have actually both paid a full month this month. There's still arrears on the account, but they're also back to work. So whilst we are acting largely at the bottom of the market, which is very, very price sensitive, I feel that the tenants that we have are more likely, if they've lost their job or finding it difficult to work in their industry, are more flexible to go out and get a job in a different industry, perhaps as a courier or a delivery guy or a warehouse operative, or in the shop where those jobs currently are. And because they tend to be quite young people generally, who are not sort of, I don't know, 10, 15, 20 years into a career, they're very much more flexible on their opportunities to go work in a different place if they've come to a halt where they were previously. So we've been very, very lucky at this end of the market with minimal rent arrears, and people are definitely going back to work, and those tenants who have had a problem are making an effort. The question really was about the safety of going into a shared house. It's a difficult one, and people, even if they tell us that they're well, they may be asymptomatic. You don't know. We have had one issue this month where one tenant felt the need to go back home to America to see her parents when she was able to, and the rest of the household, actually all agreeing with each other, didn't want her back until she'd served 14 days somewhere else, and she agreed with that policy and didn't go back to the house. So it's all about communication and how people feel. People have different risk levels about all of this.
There's a question from Patrick Kane, which I think Bronwyn you will know. He's asked, hi Jenny, I have a HMO in London, talking of London, with 2-room void for the last 6 weeks. Wow, that's a long time. It's always rent, but now it's struggling. Should I reduce the rent or wait until September when holiday season is over? Jenny, what's your thoughts?
Obviously, it depends on his own situation, but generally, I don't know what his property is like either, but generally with us, if we reduce the rent a little bit, it tends to generate some new interest. And it's probably far better to either have a rent reduction and get it let, or do something we often do, offer an incentive for a quick move in. So perhaps the first month's rent at half price, or the first, depending on, I don't know how much rent is involved here, how big the property is, but it might be an incentive that is, if you're going to do a 12-month let on a family home, the first 2 months might be at a reduced rate. Now, by doing that, you're not setting a lower rent for the entire period of the tenancy, but it is an incentive to get somebody to move in. And if you put a date on it, you know, I want somebody to commit to this by the end of the month in order to achieve this discount, it does tend to focus people a little bit. And that has been very useful as a tool with HMO rooms when we've struggled from time to time. But if you don't want a void, because in that void, you know, it's all sorts of expenses. It is better to think about, if you're going to reduce it by, I don't know, £20 a month, over a 12-month period, what does that mean to you? How many days worth of void is that worth to you? But a couple of incentives, like things like a half price rent if you can move in quickly, or it's some other incentive that might entice somebody to get over the line, is potentially a cheaper option for you than a rent reduction.
Good point. Good point. Now, listen here, YouTubers. Obviously, you are live with us tonight. So again, thank you ever so much for joining us on this live session. I do want to ask you now, if you have found this useful, to give us a thumbs up to show your appreciation of how good this is and how useful it is. So if you don't mind giving us a like, that would be fantastic. Thank you ever so much for doing that in advance. The next thing I'd like you to do is ensure that you're asking questions on the YouTube live chat as well. We do have questions in the background, but it would be great to have live questions as well to put our panel members to the test, especially that Simon. So now let's talk about our, here's a subject I was cringe-worthy about asking myself in, but I'm just going to buckle myself in, strap myself in. Here we are for the journey. This is for Simon and for Tim, so I'm strapped in ready. So we're going to be talking about beneficiary income company trusts. I can't go anywhere now without hearing that phraseology. This is whereby someone has got a property in their own name, and to avoid tax, and I'm going to use avoid, not evade, but to avoid tax, they are using a limited company to hiving off their income from their properties, which, remind ourselves, is owned by them, but they are now moving the beneficiary income to the limited company, but keeping the mortgage in their own name. Now, I'm not getting involved in this for many, many reasons, okay? So I've set you up nicely. So let's start with you, Simon, and then moving over to Tim. It'd be interesting to hear your thoughts on this, guys.
I'm going to give it, first of all, a short answer. Most mortgages will have in the T's and C's that you are not able or should not be able to sign away the beneficial interest. That's the real short answer. Yeah. Okay, so it can, if you then start structuring it in that way, then make it quite difficult to get future mortgages if you're then being looked at and examined by another lender, or in fact the same lender further down the line. They go, hang on a minute, what's the tax return in your bank statements? Tell me about this, please. And for me as a broker, that becomes extremely difficult as soon as you spot it, because there is such a thing as KYC, know your client. So I'm expected to know the client inside out, back to front, and know their bank statements and every payment they make within that bank statement before I represent them, which is quite a daunting prospect, let's be honest. Yeah, so that's the short answer. The long answer is that I believe this structure has been used relatively readily for those people who are facing Section 24 and have not gone down the route, I believe, have not gone down the route of formulating a partnership or can't formulate a partnership, okay, where you are also signing away the beneficial interest to a partnership, but it's not necessarily a limited company structure. And in that way, yeah, it's deemed as one of those other tax structures to deal with the Section 24 challenge, shall we say. I'm not going to throw it completely back at you, Simon. I believe that is a slightly untested or less robust route to deal with Section 24 than the migration from limited liability partnership into limited company and transferring the mortgages across. There's a big debate as to whether you have to bring all of those mortgages across in one go, which is the safest and most robust way to do it, or whether you bring them over bit by bit. And as I understand it, you can bring them across bit by bit if it is deemed that you are financially disadvantaged by having to bring them all across at one time. So let's say you've got 5% early redemption charges over a broad spectrum of your mortgages. There's a real good argument that you wouldn't bring those across all at that time, because 5% ERC kind of almost throws out the window the whole reason for doing it and not paying stamp duty. You might as well have just paid the stamp duty and got on with it. Yeah, that's the long answer as to where I see that structure being used. It is a difficult structure to work with. It can be worked with. However, as I'm sure when you see it, Simon, you go, right, okay. Let's find out the full story, shall we? There we go.
It's good to see you cringe, by the way. So I do love putting you in the hot seat there. Tim, what's your thoughts on this? Because obviously we're talking about terms and conditions of mortgages, but there's also other risks, aren't there?
Well, first of all, I think Simon Hodgson is far more polite than I am. The first thing I would do is I would have given it straight back to you, actually. So I think we should ask you for what you think on this. But in general terms, yeah, you do have to watch the terms and conditions. You have to be honest with your mortgage company. And one thing to remember with your solicitor, the chances are they're also representing the mortgage company, and they're also seen as officers of the court. So if we know something, we have to report it. And equally, we have to make reasonable observations. So I think that's point number one. And point number two, it's a tax issue. Back to my specialist accountant.
Okay, let's bounce back nicely there, Tim. I've got to say, your political game is getting up there. I think it's as I've heard many people talk about beneficiary income country trust, and we have to remember there is something called GAR, which stands for General Anti-Abuse Rules, which is being renamed from General Anti-Avoidance Rules. Abuse rules sounds a little bit more harsh, doesn't it? And HMRC have renamed it that way purposely. So the idea of GAR is to prevent people from using a limited company that gets a tax advantage over the not normal, but layman person, if you like. So everyday person. So as a result of that, if you're using, and I saw a YouTube audience member asking the same thing about management companies, whereby you're hiving money to a limited company when you own the assets. And I kind of think that still is part of GAR, so don't do it, because HMRC will be after you. Now, this whole GAR thing about beneficiary income company trust is a definite no-no, because one, you're going against the terms and conditions of your mortgage. And second of all, if you're moving the asset which is in your name, that's where the beneficiary income should be held. If you transfer it to a limited company, you should have CGT and you should have stamp duty land tax. And there are a lot of accountants out there saying there are no issues with BICs. Wrong. There are plenty of wrong. So I kind of think you should be very careful with this kind of structure. And it's being flouted all across YouTube quite a lot. So I'm hoping YouTube picks this up and says, actually, you should take specialist advice. There are companies out there that, and we've got to remember this, and Tim, I don't know if you can kind of gauge on this one, but there are barristers out there that will say, yes, do this structure because it will save you tax. And what we'll do is we'll build a war chest to defend this particular case against HMRC in court. And that's what a war chest is. That's what they're going to use it for. But what they don't tell you is that you have to now pay that barrister £500 an hour to defend you in court. So if you've got this huge target on your backside and HMRC decide to take a punt at you, do you have the emotional appetite as well as the financial bank account to finance it? Tim, what's your thoughts on that one?
HMRC have changed their attitude, as far as I'm aware, significantly in the last 5-10 years. They've become much more aggressive in numerous areas. And I think that's only going to be continue to be the case, because the government has been handing out billions and billions to the public and to companies, and somehow they're going to have to get that back. And so I think HMRC will be tighter and tighter. And I think we're going to be looking at issues of the rich and the poor. And I think people who are looking to make advantages on tax rules, they're going to have to be very careful. So I think HMRC will tighten up further and further, will challenge. And I think a lot of people do take these creative schemes far too naively from so-called clever tax barristers, things that haven't been checked. I would personally never go in with a structure that hadn't already been checked and tested against HMRC, and they confirmed it actually worked. These new ones that are terribly clever but don't work, I think, are incredibly risky. And if you're at all risk averse, I would avoid them like the plague.
Yeah, I mean, there's one particular company not to be mentioned for lawsuits. I appreciate I'm not in America, but still, nevertheless, there is one company that is blatantly lying when they're saying we will get HMRC clearance for you. Well, in 2018, HMRC said they're not giving any more clearances. So how on earth they're getting a brand new clearance letter for you is beyond me. So do your due diligence on these companies that are literally lying to you to get you into this kind of structure framework. So do be careful. And I appreciate I'm going to get slated for that, but this is just my opinion. And it's something that I've seen a lot of people being, it's that shiny penny to say, this is something that we should be doing. FOMO, another one, fear of missing out. Oh, I've got this limited company. This is a new thing. Let's go into it because we don't want to be last, do we? Well, don't be first and then get shot. That's what I would be saying to you. So just to be careful with these tax structures and what people say about it. And I think that's pretty much it for me from a tax perspective. I'm going to go ask a question about now. There's Helen Davis has asked a question. It says, should I be buying a small shop and one flat above with parking at the moment, or should I wait? Southwest area, small market town. Let's go to Bronwyn and Paul, who's been pretty quiet on that particular one.
Well, yes, Helen, it depends what you're trying to achieve and what your strategy is. And when you say not now, but later, are you waiting for the prices to drop? If you know your area really, really well, you'll know whether this is a good opportunity or not, because you will have done your due diligence already. You would have worked out what your return on investment could be. You perhaps already know some of the permitted development changes. Now, I don't think we've talked much about those today, but there've been a huge raft of changes in permitted development planning. But in terms of a shop and a flat, you've got obviously a retail opportunity, but of course we know what's happening to high streets. You could convert that shop to residential if you would be allowed to do that. Again, you need to take expert advice. So there's too many questions to ask really to answer your question yes or no. It's I'm happy to talk offline, as I am with anybody around this sort of thing, but I haven't spotted anything else in your question that I can comment on, unless Paul has. Of course.
Can I possibly interject a touch there?
Oh, I don't know.
Sorry, guys. If only because it kind of crosses over, one, into the mortgage market, and two, how that kind of security gets valued. Now, don't forget, a commercial part of a property is valued on a commercial basis. Seems fairly obvious, doesn't it? However, what we've got to remember is that there's something that's called a strength of covenant. Okay, so the commercial property could be valued more by the type of tenant you have in it. So let's say you have retail property, and retail can be Costa. Now, if you've got Costa, that is the gold-plated, the industry standard. And it is possible in some circumstances to buy commercial property for a couple of 100,000, okay, attract in that kind of tenant, and your property can be revalued up to 2 to 3 times more than you paid for it, just because you got that kind of tenant in it. But guess what? It works in reverse. Yeah, if you now don't have a tenant in that building, in that part of the building, yeah, its value has decreased, markedly decreased, and potentially up to 40% decrease it is being predicted. So we would really need to know where that is in terms of in the southwest, which market town it is. And you then need to work out, is it on the fringe of retail? And if so, yeah, from what Bronwyn's saying, definitely explore the ability to potentially with education, and certainly that's where Bronwyn comes in without doubt. I can't say I have enough education in that sphere as to whether you can exercise permitted development rights to be able to turn the downstairs into residential and create something that's got a much more stable profile. And it might be that you can buy it at a discount because of its strength of covenant being really weak, then do a change of use. Yeah. Sorry, I interjected, and maybe that was a long answer. I'm really sorry, guys.
Yeah, what about the floodplain, Simon? What about that?
Well, generally on the ground floor, yeah, in the southwest, yeah, this could be in Western Supermarket, yeah,
Could be. Paul's got an answer.
Go away, Simon. I won't say which one. I totally endorse what Simon Hodgson just said. I think the only thing I'd add in addition to what Bronwyn's already said is, if the opportunity is there and the price is right and you're going to hold it long term, then buy it now. But be careful. If it's going to be based on a commercial valuation, then make sure it is a realistic valuation. The belief is definitely the next 6-7 months is going to be a great time to sell. So why are they selling? But again, if it's a realistic price, the one thing to be cautious of, although all these planning permission classes are going to be changed in September, there are still going to be restrictions as regards to the high street. And by the high street, I mean the main high street. Local councils will not want you to redevelop a shop in the main high street areas. So, and that'll be excluded from the permitted development classes order. So, if the price is right and you see a great opportunity, then pursue it. But don't just think, oh, everyone's buying that now. Just be careful.
So the next question we've got is around about future properties. What are you guys investing in right now? What are you guys planning on doing? Let's start with Jenny, and then we'll go to Bronwyn. Let's get our own views now, because it's one thing to have an opinion, but isn't it another thing to actually say what we're doing, which really is the proof of the pudding, isn't it? So Jenny, what is your property focus, and what are you buying next, and are you buying next?
Okay, so as I said earlier, we have a 5-year plan to retirement. And as part of that, we are selling anything that we've got out of area. We live in the Southampton area. I only want properties that are on my own patch. We're selling them one a year because of the taxation costs. We're turning eventually our HMO properties into single family lets. We're making it very easy for ourselves. I want 3 or 4 bedroom houses that families can move into and stay in long term whilst their children are at school. What we see from the portfolio that we have at the moment are that the 2 beds probably have a lifespan of 4 to 5 years for a tenant, because they go in there as a young couple and then they have a family and then they have the second child and it's not big enough any longer. The 3 bedroom houses we have tend to have tenants in them for a very long time. So we're turning eventually our HMO properties, which we will sell, into reinvest that money into single lets. And we will be holding a very low leveraged portfolio, reduced numbers of properties than we have now, but with minimal leverage. Because that will then be safe retirement income, and we're looking for long-term family homes. Because we're at that stage in our property journey. We've been doing this for over 20 years, and we're of an age now when we want to make things easy. We've tried all sorts of things, and it's been exciting and it's been fun, and sometimes it's been scary. But now we are looking towards comfy retirement. And we are currently buying a 3-bedroom house locally to us. And we already have a tenant. We had a tenant in mind, focused, before we chose that property. And that property was chosen almost with the help of that tenant.
Yeah, there we go. Wonderful. That's great, Jenny. And, you know, again, everybody's different, aren't they? So for me, year 6, I've got HMOs, holiday lets. So holiday lets are doing really well. It's interesting. I'm finding that some people who've got larger properties who want, rather than move house, they want to renovate their house. So some people are literally gutting their houses, building extensions, and that family needs somewhere to live. So I've got 2 holiday lets in my village. One's let for 4 months. I've just had an inquiry for the one I'm actually living in at the moment. Well, they want it for 3 months. So that's really interesting. So the holiday let for me has become more of a sort of, oh, this is somewhere where I can live whilst my house is being done up. Great market, because it's short-term letting. We get really good income for that. I'm buying at the moment. I'm buying a 7-bed HMO that's next door to one of my guest houses. So I have a guest house business, short-term letting, mainly for emergency housing for councils. So that's been a fantastic strategy during this COVID lockdown, because, you know, councils they don't have the resources. They need to place people, and street homeless as well. So that's been quite a big growth area for me over the last couple of years. So I'm expanding that business. That's a trading business, very different. And because all my other properties are highly mortgaged, interest-only mortgages, I want to try and pay debt down. So I'm doing developments. I'm just selling 8 houses at the moment. I'm looking for a second planning permission for 6 houses. And I put a bid in on a property that is with a receiver. So a receiver's selling it because the people went bust. So I think there'll be opportunities there where people, unfortunately, have overspent on deals and can't see them through. So that's going to be my focus.
Who's next?
Who's next?
Thanks. Well, it's a coincidence, like Jenny. I'm looking to retire at age 40, and so the trouble is, I've got a lot more properties to sell. So selling at 1 a year, I'll be 80 before I can get rid of the damn things. But hey, that's life. I'm looking at small developments, developments of properties less than a dozen, so I can avoid Section 106, keep it simple. Really looking at it as a buy-to-rent strategy. If you don't know what that means, by all means, give Bronwyn a call. I'm still looking at HMOs in my local area because that, I feel, is a way to go because certainly Birmingham is definitely going to be a growth area with HS2, and it's got a large youthful population and student population, which will be looking to stay in the area. And then lastly, I'm looking for large properties on a large estate. I say it's a large estate with land up to about 10 acres. So I'm looking to future-proof for the family. So we're looking to migrate and have several generations on one plot of land. So that's what I'm currently looking at the moment. So if you've got any land in Oxford area, within about 10, 15 miles of Abingdon, then by all means, give me a shout. Thank you.
Simon.
Check that out. Much like Tim at the moment, I think really in terms of sitting on my hands. Although I'll temper that within the background, I'm in the middle of working with a group of individuals. We're setting up a passive housing development company and just going through looking at some sites. I understand right now isn't necessarily the right time to start building out, but we're putting all the framework in terms of systems, etc., the people together, and starting to look at sites with the view that once we know exactly where the market is going to sit, if it is bottoming out, where it's going to finish bottoming out, and then looking at ways that we can passively build at roughly the same build cost as your standard average house, but create additional value on a site. So find sites that don't necessarily stack up currently at the moment on normal resale values, but with higher end resale values of passive houses, then stack up and kind of do sites of between 5 and 10 to 12 houses per site. So if anyone on this YouTube, Simon, not Facebook, I'm back in the crowd. No. If anyone knows of land in the southwest area, please do reach out. Tim.
Yeah, going back to basics, I think I'm relying on the basic laws of property. Number one, a bargain is a bargain. So at the moment, there may be bargains available. I think they're few and far between, and there'll be more next year. Number one for me, property is a medium and long-term investment. Unless you're doing things like flips, it's medium and long-term. So I think there's a danger of getting too worried about what's going to happen in the short term. Thirdly, it's all about yield. If you're not looking to sell, it's all about yield. And again, I think you have to be very careful when you look at yield, because suddenly things are changing. Holiday lets died for a while, now are coming back. Is the high street dead? Are offices dead? So I think even the question of yield is nowhere near as easy as it once was. And lastly, if it's all add value, because there are so many people who just want to buy property at its real value, but actually need to add value. So what am I going to do? Well, as I said earlier, I want to be very adaptable. I don't know what's going to be like in 6-9 months. I have no idea what the economic circumstances are going to be. I've got my best guess. I don't know what the government will do. In the last week alone, they've virtually ripped up the rule book in terms of planning, which has changed bigger, more changes since 1947. And that's just the last week. So goodness knows where that'll lead us. So there could be all sorts of opportunities. So broadly, I'm going to sit on my hands. Unlike the other guys who've got their plans until they're 40, I'm being a bit older. So I've got a 12-year plan, which should take me to my mid-90s. So I should be all right. I'm going to do personally, I've been clearing debt, and I've got a property, a block of flats now with no mortgage. So at some stage, I'll be looking to mortgage that, raise cash, and do something next year, but I have no idea what. But there will be bargains, I'm sure. But I want to be adaptable and jump in when someone else has created those opportunities.
Yeah, I'm just a final point on that. I'm going to agree with Tim that there are plenty of opportunities, but for me, next year. So I'm not looking at properties this year. And indeed, I'm looking further afield. So I'm looking at the US and looking at the kind of yields there. The property price in the States, you can get a lot more property for the money you can get in the UK, and the yields are better. So the yields, funny enough, in the States is 15%. So it's a lot more than you can get in the UK. So we're looking at doing things like that, a bit more exciting properties. Simon Hodgson may not be able to give me a mortgage over there, but we'll get him over to the States. In fact, we might even do a little YouTube channel over in the States together. That'd be quite cool. Hey guys, to do that. So that's my view. So now we are up to time. So Bronwyn, why don't you kick us off with the evaluation? We don't have time to go around the panel to get their final views, but Bronwyn, why don't you say your final says?
Thanks, Simon. I think if I can summarize, the key really about the current marketplace is to be informed and educated. You've heard from all of us, we've all got different perspectives, different understanding, and we've been doing this for quite a while. So I think if you're listening to this and you've had a question, you recognize that you've got to work with experts, but you've also got to get a good education. So that's what we're here helping you. All of us individually can help advise you. I've been doing a spotlight on the experts. So each one of us will have a spotlight. We've done tax. So if anyone's interested in seeing that back, we can give you access to that. We've done mortgages, spotlight on the mortgage. Yes, Simon. So that was a fantastic session as well. And we're covering so much in these sessions, and it doesn't cost you any money, which is wonderful. So the next one we've got is Spotlight on Lettings with Jenny. So that's going to be great. That's on the 17th of August. So 2 weeks tonight will be that one. So put it in your diary. And yeah, informed and educated is the key theme for me. I've got if anyone's interested in raising funds, I've got a one-day course coming up. So connect with me, email me. It's going to be all about how do you find investors? How do you find funding for deals? And I think if people are sitting there on their hands, I think the best thing is to start learning, get an education, get learning, because then you know what good looks like when it comes along.
And talking of that, Bronwyn, the next session for this event is Monday, the 7th of September. So if you have not stayed tuned and put things in your diary, make sure you do that. But other than that, I just want to say as well, thank you on behalf of all panel members. Thank you and have a great evening. Cheerio all.
Cheers. Bye.
Bye.